Hello, welcome all. This side Abhilash. So in this session, I am going to talk on the monetary policy. So we have a separate session, separate unit on the monetary policy. So we will try to complete all the details about the monetary policy and its function in this session. So don't miss. Please watch it once it's uploaded on the YouTube. So let me start with the definition of monetary policy. Monetary policy refers to the credit controls measures adopted by the central bank of a country. Monetary policy as policy employing central bank's control of the supply of money as an instrument for achieving achieves of general economic policy. The objectives of monetary policy. The following are the principal objectives of monetary policy: full employment, price stability, economic growth, balance of payments, exchange rate stability, neutrality of money, equal income distribution. So now just first understand the first objective of monetary policy is the full employment. Full employment has been ranked among the foremost objective of monetary policy. It is an important goal not only because unemployment leads to wastage of potential output, but also because of the loss of social standing and self-respect. The second objective of monetary policy is the price stability. One of the policy objective of monetary policy is to stabilize the price level. Both economics and favor this policy because fluctuations in price bring uncertainty and instability to the economy. The third, economic growth. One of the most important objective of monetary policy in recent years has been the rapid economic growth of an economy. Economic growth is defined as the process whereby the real per capita income of a country increases over a long period of time. The fourth objective of monetary policy is the balance of payments. Another objective of monetary policy since 1950s has been to maintain equilibrium in the balance of payment. The fifth objective of the monetary policy is exchange rate stability. Exchange rate is the price of a home currency expressed in terms of any foreign currency. If the exchange rate is very volatile, leading to frequent ups and downs in the exchange rate, the international community might lose confidence in our economy. The monetary policy aims to maintaining the relative stability in the exchange rate. The sixth one is the natural neutrality of money. Economists such as Wickest Robertson has always considered money as a passive factor. According to them, money should play only a role of medium of exchange and not more than that. Therefore, the monetary policy should regulate the supply of money. The last is the equal income distribution. The many economics used to justify the role of the fiscal policy is maintaining economic equality. However, in recent years, economics has have given the opinion that the monetary policy can help and play a supplementary role in attaining an economic equality. Type of monetary policy. The monetary policy design changes as per the goal set for the monetary policy and the emerging economic scenario. The monetary policy is characterized as expansionary policy and contractionary policy, counter cyclical policy, rule based policy, or discretionary policy. So we have a five types: expansionary monetary policy, contractionary, then counter cyclical, then rule based monetary, and fifth one is discretionary monetary policy. So let's discuss one by one all the types. The first is the expansionary monetary policy. Expansionary or easy monetary policy aims to encouraging spending on goods and services by expanding the supply of credit and money by lowering the policy rates, lowering the reserve requirements, and the purchasing the government securities from the market. The second type of the monetary policy is contractionary monetary policy. Contractionary or tight monetary policy aims to preventing inflation by contracting the money supply. Contraction in money supply is achieved by increasing the policy rates and increasing the reserve requirements and purchasing the government securities from the market. The third one is a counter-cyclical monetary policy. Counter-cyclical monetary policy aims at moderating the cyclical fluctuation in the economy and stabilizing the economy around its trend path by following counter-cyclical measures. The fourth type of monetary policy is the rule-based monetary policy. Under rule-based policy, money supply and the related variables are controlled by predetermined rules, norms, and standards. The central bank authorities cannot use their discretion to change the values of these variables. The fifth and last type of the monetary policy is discretionary monetary policy. Discretionary monetary policy allows the central bank greater autonomy in the conduct of monetary policy. Under such a policy, rather than getting constrained by preset rule, the central banks, after assessing the emerging economic scenario, using its own judgment and can change the value of money supply and the related variables. So these are the instrument of the monetary policy. So in the last slide, we have discussed the types of the monetary policy. Instruments of monetary policy. The credit control is an important tool used by Reserve Bank of India, a major weapon of monetary policy used to control the demand and supply of money in the economy. Quantitative and qualitative. First, the bank rate. So as per the quantitative method, we for the there are the quantitative instruments of monetary policy: bank rate, open market operation, variation in required, repo rate, then liquidity adjustment facility. Right. So on the qualitative, we have a rationing of credit, margin requirement, variable interest rate, regulation of consumer rate, and licensing. So we will discuss all the quantitative and qualitative instruments now. So qualitative instruments, bank rate. The bank rate, also known as the discount rate, is the oldest instrument of monetary policy. Bank rate is the rate at which the RBI discounts, or more accurately, open market operation. Open market operations are the means of implementing monetary policy by which a central bank controls its national money supply by buying and selling government securities or other financial instruments. Variations in the reserve requirement. The Reserve Bank also uses the method of variable reserve requirements of control credit in India. By changing the ratio, the Reserve Bank seeks to influence the credit creation power of the commercial banks. Repo rate and reserve repo rate. Whenever the banks have any shortage of funds, they can borrow it from RBI. Repo rate is the rate at which bank borrows rupees from RBI. Current repo rate is 8% as on the January 2004. So now I think current repo rate is around 7%. So let me check once again. Current repo rate. So in 2017, we have a current repo rate is around 4%. So the Reserve Bank of India Monetary Policy Committee, the MPC, kept the repo rate unchanged at 4% for the 9 consecutive time while maintaining an accommodative stance as long as necessary. So this is announced by the RBI Governor Shashikanta Das. Liquidity Adjustment Facility. It is a tool used in monetary policy that allows banks to borrow money through repurchase agreements. These arrangements allow banks to respond to the liquidity pressure and is used by government to assure basic stability in the financial market. Qualitative instrument. Credit rationing of credit. Credit rationing is a method of controlling and regulating the purpose for which the credit is granted by commercial bank. It aims to limit the total amount of loans and advances granted by commercial bank. Margin is the difference between the market value of a security and its maximum loan value. Marginal requirement of a loan can be increased or decreased to control the flow of chart. Publicity: RBI uses media for the publicity of its views on the current market conditions and its direction that will be required to be implemented by the commercial bank to control the unrest. Regulation of consumer credit: if there is excess demand for certain consumer durable lending to their high prices, central bank can reduce consumer credit by increasing down payment and reducing the number of installments of repayment of such credit. Moral suasion: the moral suasion means persuasion and request to arrest inflationary situations. Central bank pursues and requests the commercial banks to refrain from giving loans for speculative and non-essential purpose. Direct action: under the Banking Regulation Act, the central bank has the authority to take strict action against any of the commercial bank that refuses to obey the direction given by the Reserve Bank of India. Significance of monetary policy: control inflation or deflation, availability of supply of money and credit, integrated interest rate structure, effective central banking, long-term loans of industrial development, creation of financial institution. So let's see one by one. The control, these are the significance of monetary policy. Control inflation or deflation. Monetary policy is the policy used by the government of a country to control inflation or deflation in an economy. This policies has been implemented by the central bank through the Ministry of Finance. Availability of supply of money and credit. Monetary policy is concerned with the charges in the supply of the money and the credit. It refers to the policy measures undertaken by the government or central bank to influence the availability, cost and use of money, credit with the help of monetary techniques to achieve specific objectives. Integrated interest rate structure is an underdeveloped economy. There is absence of an integrated interest rate structure. There is wide disparity of interest rates prevailing in the different sectors of the economy, and these rates do not respond to the changes in the bank rate, thus making the monetary policy ineffective. Effective central banking: to meet the developmental needs, the central bank of an underdeveloped country must function effectively to control and regulate the volume of credit through various monetary instruments like bank rate, open market operations, cash reserve ratio, etc. Long-term loan for industrial development. Monetary policy can promote industrial development in the underdeveloped countries by promoting facilities of medium-term and long-term loan to the manufacturing units. Creation of financial institutions. The monetary policy is in a developing country must aim to improve its currency and credit system. More banks and financial institutions should be set up, particularly in both areas which lack these facilities. Recent trends in the monetary policy. This is the data between the 2014 and 15. On the 5th August 2014, the governor of the governor of RBI, the Mr. Raghuram Rajan, has presented the third bi-monthly monetary policy statement for the year 14-15. Repo rate unchanged at 8%. CRR, cash reserve ratio, unchanged at 4.0. SLR reduced by the 50 basic points from 2.5% to the 22%, with the effect from the fortnight beginning on the 9th August 2014. The Reserve Bank will continue to carry forward its banking sector reforms agenda. The fourth bi-monthly monetary policy statement is the schedule on the 30th September. So this is all about the monetary policy, its functions, its types, and its significance of monetary policy we have discussed till now. If anyone is having doubt, they can ping me or they can text me on my WhatsApp number. Thank you. Best wishes.